You hear these words all the time, right? Interest rates, inflation, investments. They're kind of like the background music of the financial world. Well, today, we're going to crank up the volume and really listen. We'll decode that rhythm and figure out how it all connects to your money.
So how is it possible that a decision made by like a dozen people in a room can make the stock market either skyrocket or totally tank? It seems kind of crazy, right? Well, that's exactly what we're going to trace today. Let's follow the signal. All right, so our story begins with the folks who have their hands on the master switch for the entire U.S. economy.
And who's at the controls? That would be the Federal Reserve. You've probably heard them called the Fed. Think of them as the country's central bank. Their main gig is keeping the economy stable, and their number one tool, the big lever they pull, is adjusting interest rates. And that is exactly why Wall Street and investors everywhere hang on every single word the Fed says. You know, when they flip that switch, the effects ripple out across, well, everything. We're talking from how much it costs a company to build a new factory, all the way down to the value of the stock sitting in your investment account.
So, this brings us to a really simple but super helpful way to picture what's going on. I like to call it the Great Rate Seesaw. It's all about this push and pull, this inverse relationship between interest rates and stocks.
Okay, so picture this seesaw. On one end, you've got low interest rates. When that side is down, money is cheap to borrow. That encourages companies and people to spend and invest, which gets the economy humming. At the same time, super safe investments like bonds, they're not paying much at all. So where does the money go? Investors chase bigger returns in the stock market. But what happens when the seesaw tips the other way? Now, high interest rates are up. Borrowing gets expensive, which kind of puts the brakes on the economy. And all of a sudden, those boring old bonds are looking pretty good, offering a nice, safe return. That pulls money out of the stock market, which can really put a damper on stock prices.
So the Fed isn't just messing with rates for fun, right? There's a reason. And a big one they're always keeping an eye on is this massive economic force. Let's call it the inflation dragon.
Now, the goal isn't to slay the dragon completely. A little bit of inflation is actually a sign of a healthy, growing economy. The Fed is just trying to tame it. That sweet spot they're always aiming for is somewhere around 2 to 3%.
So what is inflation really? Honestly, the simplest way to think about it is as the silent thief in your wallet. It just means that your dollar doesn't buy as much today as it did yesterday, because prices for, well, everything are going up.
And when that inflation dragon gets out of control and starts breathing too much fire, it's a problem for literally everyone. It eats away at your savings. Your paycheck doesn't stretch as far. And it's not just us. Companies feel it too. Their costs go up, which squeezes their profits, and, you guessed it, that can make their stock prices fall. So how do you fight back? Well, the Fed has a pretty standard playbook for this. Step 1. When inflation gets too high, they start raising interest rates. That makes borrowing money more expensive for everyone, from you getting a car loan to a business wanting to expand. This causes people and companies to pull back on spending. It's basically an engineered slowdown of the economy, designed to get demand back in line with supply. And that's how they tame the dragon.
Okay, here's where it gets a little more nuanced. It's super important to know that when the Fed raises rates, it's not like a tidal wave that hits the whole stock market shoreline equally. It's more like a series of ripples that affect different parts of the market in very different ways.
Take the financial sector, for example. Banks, they can actually benefit because, hey, they get to charge more for loans. But then you look at growth stocks. Think tech companies. They often get hit hard. Why? Well, a lot of their value is based on the huge profits they're expected to make way down the road. But when interest rates are high, those future profits are worth a lot less in today's money. It's a finance concept called discounted cash flow. And then, of course, you've got sectors that carry a ton of debt, like utilities or real estate. For them, any increase in interest rates means their borrowing costs just shot up, which is never a good thing.
All right, let's take a step back and put all these pieces together. What's the big picture here?
So, what have we learned? Let's do a quick recap. Number 1, the Fed is the pilot, using interest rates to steer the economy. Number 2, think of low rates as a tailwind for stocks, pushing them up, and high rates as a headwind, pushing back. 3, the main reason the Fed creates that headwind is to fight off high inflation. And finally, and this is so important, not all stocks feel that wind the same way. Different sectors will react very differently.
But, and this is a big but, we have to remember the market is a huge, complex beast. As the saying goes, there are tons of factors at play. Interest rates and inflation are definitely 2 of the heavy hitters, but there's still just 2 pieces of a much, much bigger puzzle.
And that really leads us to the big question, doesn't it?
If interest rates and inflation are just two of the big currents, what else is out there pushing and pulling the market? Things like how much profit companies are actually making, what's happening politically around the world, or even just how confident people are feeling about the economy. Figuring those out, well, that's the next step in your journey as an investor.